Hi buddy, this is Ajay and welcome to Accounting with Ajay. So let's talk about standard costing and variance analysis today. People tend to plan their future. They set standards to follow. For instance, I set a standard to wake up at 4 a.m. Sometimes I do wake up at 4 a.m. but sometimes I fail to do so. Similarly, businesses set standards with respect to their cost and revenues. For instance, a jam manufacturing company expects to use 2 mangoes as raw material to produce a bottle of jam, and they expect to buy each mango at $1.5. So as we know, the expected or the standard material cost to produce a bottle of jam is $3. Though the standard material cost is set as $3, sometimes the actual material cost could vary. In accounting, we call the difference between the standard cost and the actual cost as variance. Let's assume that our jam manufacturer incurred a cost of $6 to produce a bottle of jam. So here, though the company had expected to spend $3 for direct materials to produce one bottle of jam, they ended up in spending $6, and the management must be worried about this. And they want to analyze the reasons for the variance. There could be two broad potential reasons for this variance. Either it could be due to the changes in the price of mangoes. The price might have gone up. Or it could be due to the changes in the material usage in producing a bottle of jam. They might have used more mangoes than expected. So let's talk about these two reasons further. The first potential reason is the difference between the actual material price and the standard material price. This is called as material price variance. For instance, let's say that we purchased the mangoes for $3 each against the standard price of $1.5 due to some adverse market condition. Then the raw material cost for 2 mangoes to produce one bottle of jam would be $6. Since the actual cost is $6 and the standard cost is $3, the material price variance is $3. That is the difference between the standard material price and the actual material price for 2 mangoes. Here the actual material price is higher than the standard material price, and it shows the adverse condition in the market. Therefore, we call it as an adverse variance, and it is denoted by the letter A. A stands for adverse. By the way, sometimes the actual price could be cheaper than the standard price. In that case, the material price variance would be a favorable variance and denoted by F. F stands for favorable. Okay buddies, so let's move to the second potential reason. The second potential reason is the difference between the actual usage of mangoes and the standard usage or the expected usage of mangoes. This is called as material usage variance. Let's say we purchased the mangoes at $1.5 as expected. However, we used 4 mangoes instead of 2 mangoes as set in the standard. So the actual usage for the actual production level is 4 mangoes, and the standard usage for the actual production level is 2 mangoes. Therefore, the material usage variance is 2 mangoes, and it is an adverse variance since we have used more than what we had expected to use. Oh, wait. There's a mistake. Can we have mangoes in accounting? No. We can use only monetary figures in accounting. We can't use mangoes and coconuts in accounting. Therefore, the adverse variance of 2 mangoes should be multiplied by the standard material price of each mango, that is $1.5 each. So the material usage variance is $3 adverse. But you might have noticed a point here. We calculated the standard usage and the actual usage for the actual production level. In this simplified example, the actual production level is just 1 bottle of jam. Therefore, the standard usage is 2 mangoes and the actual usage is 4 mangoes. However, if the production level had been 100 bottles of jam, then the standard usage would have been 200 mangoes and the actual usage would have been 400 mangoes. Then the material usage variance would have been 200 mangoes, and that should be multiplied by the standard price of $1.5 and then it would have been $300 adverse. So buddy, I hope you all are clear with the basic idea of the material price variance and the material usage variance. The sum of material price variance and the material usage variance is called as material cost variance. We shall talk about this in the next video. So please watch the next video for a comprehensive example on material variances. See you then.